what retained earnings are is that portion of net income that we did not pay out in dividends. We kept it within our company. And then you'll see less cost of common stock held in treasury. Treasury stock is just you went out in the open market and you bought back your own stock. That's treasury stock. Okay, so that's just some various items on the balance sheet. Let's talk about the income statement, which is on page 8. And actually, when you prepare your financial statements, your income statement is prepared first. That's the first item you prepare. But let me go over the various accounts. You have sales. We all know what that is. Let's say I sell this eraser. That's my sales. And if it was somebody bought it for $5 and I sold one eraser, my sales is $5. Cost of goods sold. That is the point that you have transferred from the balance sheet. Remember with that inventory? That's what we bought it for. When we sell it, we transfer it from the balance sheet to the income statement. So for example, if this was showing on my balance sheet for $1, this eraser, because that's what it cost me, my cost of goods sold, my inventory would now be 0 because I'm transferring it, and my cost of goods sold would be $1 because I'm selling this eraser. Okay, when you subtract your cost of goods sold from your sales, that gives you gross profit. Selling, general, and administrative expenses are your everyday expenses incurred in the operating of your business. We're going to subtract that from gross profit to end up with income from operations. In this case, they have some other income and expenses, and they're kind of grouping them out, but they have interest expense. You know, maybe if we borrowed somebody money on a note, they're paying us interest. Or excuse me, we borrowed money on a note from somebody. Let's say we have a note, we're paying interest, that's interest expense. Dividend income, maybe we have stock in another company, and we've gotten dividend income for that. Interest income, that's what I was talking about previously. Interest income is, you know, maybe we borrowed somebody money on a note and they've had to pay us interest for that. That's income to us. And then they have some other items net on there, and they have a total. Again, we're going to go ahead and we're going to subtract that from income from operations to arrive at our income before income tax and extraordinary items. Income taxes, that's obvious what that is. We're subtracting that. That gives us income before extraordinary items. In our case, we have an extraordinary item, which is less applicable income tax benefit of $32,000, and that's being subtracted. And then we finally arrive at net income. What an extraordinary item is, just so you know, maybe you had a major fire, something like that, and you sustained a huge loss, and maybe you got no insurance or whatever portion wasn't insured. That's an extraordinary item. It's not the everyday happening of your business. So again, then we arrive at net income. Okay, so that's our net income. If you look, it shows retained earnings beginning of the year. It shows dividends paid and then retained earnings at the end of the year. What you do is you take your net income, you add, and it's not really done in this, it's usually your beginning of year retained earnings plus net income, but it doesn't matter. For our purposes, it makes no difference. But you're going to add your retained earnings at the beginning of the year and your net income. You subtract the dividends you paid out, and that gives you your retained earnings at the end of the year. So that's basically how you've taken your net income from your income statement, and you're able to transfer the net income amount minus any dividends you paid into your balance sheet. So that's basically the connection between the income statement and the balance sheet. That's how the one goes through to the other. There's another statement, which we're not going to go through, but there is, if you're interested yourself, there is a, on page 10, statement of cash flows, and you're free to go through it yourself. But we pretty much went through all the items, the actual what they're called, so I think you'll be fine with that. So now I want to turn to the assignment. You have a practice, which shows as practice exercise high flyer and practice solution high flyer. I want you to look at both of those. You might want to make a printout as we're going through these ratios. And let me tell you first, ratios in and of themselves are pretty meaningless. You need something to compare them to. And they're only one item in a lot of different items that are important. They're just one item we're going to look at to determine information about a company. But what you can do with ratios, you can do a trend analysis where you compare the company to itself over several years, or an industry analysis. You can compare what's going on in the company to the rest of the industry and see if they're doing better or worse than the rest of the industry. So let's go through how we calculate this. And for your assignment, you don't have to do this. Your assignment is assignment number 1. It shows up out there. All you're going to have to do in your assignment is literally take your figures and transfer them from the PDF file you have. Those figures, you're going to transfer them onto the template, the small biz template, and all the calculation is going to be done for you. But I thought it'd be good to see how it works just so that you're aware of what you're doing. And you might want to try some of the practices too. But first we're going to start with ROE. Return. Oh, before we do that, let me go through. If you look at your solution, and you look at the bottom of the solution, it shows calculated totals, and they have current assets, current liabilities, total liabilities, and liabilities plus equity. It's always a good idea to kind of total it ahead of time, and it makes the calculations easier. They're much faster. But for example, the way they came up with current assets for the current year, you look at your current assets. So in our case, it's our cash, accounts receivable, inventories, and prepaid insurance added together. When you're looking at total assets, it would be the total current asset amount plus your long-term assets. Okay, and you're doing that each year. Looking at your current liabilities consists of your accounts payable, your notes payable that are due in 10 months, and your wages payable. Those are all considered current liabilities. Quick way to do your total liabilities is just take your total current liability figure and add to it your long-term liabilities. That'll give you total liabilities. And to determine your liabilities plus equity, you can take your total liability figure and just add on the equity figure, which is your stockholder or owner's equity. So if you look, you'll see, you can add them yourself, you'll see that the totals come out right for the current year and for the previous year. So let's talk about ROE real quick, and that's our first item, return on equity. And it shows you, if you look at the solution, it is your net income divided by your average equity. Whenever you see the word average, the way that's determined is they take the current year plus the last year. In our case, it's periods in other cases, but it's the current year plus the last year. You add those two figures together, you divide by 2. That's how you get the average. So if you look for ROE, net income, if you look on the sheet, you see net income's $20,000. Our equity is $196,000 for the current year, $176,000 for the last year, so we divide that by 2, and we end up with $20,000 divided by $186,000, and that tells us our ROE is 10.8%. What ROE is, I'm going to just talk about this for a minute. ROE is our profit margin plus our asset turnover plus financial leverage, all calculated together. This is the most important item. This is what everybody's looking at to determine how you're doing. You can compare it to yourself. You can compare it to the industry. But what this shows is profit margin shows us what's happening on our income statement. Asset turnover and financial leverage show us what's happening on our balance sheet, what's happening on our asset section of the balance sheet, and what's happening on the liability and owner's equity section. So that's why this is such a critical ratio. But if you're doing really well compared to the rest of your industry, everybody's going to emulate what you're doing, and they will all probably have higher ROE, so you won't be higher for longer. But this is really important, and if you don't have a high enough ROE, you can work backward through these various ratios to find out what your problem is.